Good afternoon and welcome to Chapter 3, The Adjusting Process. We're going through each one of these chapters. What we're going to talk specifically about here in Chapter 3 is that there's adjustments that businesses make in their financial statements that really, they don't have source documents that come into the business. And what we're going to specifically talk about first is why we do adjustments. And we're going to talk about the differences between what some people call what's called cash basis accounting and accrual basis accounting. As you recall from Chapter 2, one of the things that I talked about in Chapter 2 was that for expenses and revenues, it was cash in and cash out. Well, that's not 100% true because you have expenses. For example, if you bought some type of a long-lived asset like a truck, well, when you buy that truck, there's cash out. Maybe you spend $10,000 cash for that truck, but that truck is going to give you useful life for, say, maybe 4 years. So you don't want to expense all $10,000 in a year when you buy it. You want to expense it over a period of time. So what we're going to talk about is the difference between the two. And we're going to start with that. And then we're going to specifically address things in accrual basis accounting that we look at, that we do what are called adjusting entries. Now let's talk about the differences. In cash basis accounting, revenue is recorded when cash is received. So let's just go on and then I'll come back to that. Second is when expenses are only recorded when cash goes out, and it's not allowed under GAAP. And you might see a lot of small businesses might use this type of accounting approach. And in fact, a lot of farm businesses will use this approach because that way they can manipulate their earnings just a little bit. If you ever saw a farmer that had a bumper year and made just a whole bunch of crops, well, what they might end up doing is if they had a great year, they might go out before the end of the year and buy a brand new pickup truck or a brand new harvester or something to reduce their taxable income. They're using something called cash basis accounting, which they can, but it's not allowed under GAAP. Now, as far as accrual basis goes, revenue is recorded when it is earned, and I'll come back to each one of these in just a minute. And expenses are recorded when incurred, and it's used by most businesses. So what that means is, let's say you do work for somebody, but they're not going to pay you for a period of time. Well, if you do work and they're not going to pay you for 90 days, you report the revenue when you did the work. You don't report the revenue when that particular customer sends you the check. You report it when you did the work. By the same token, you report the expenses that are associated with the work that you did for a customer when you report the revenue. And what you're doing is something called matching. And we'll get into matching here in just a little bit. Okay? So we're going to talk about a time period concept, which some books will call this periodicity. We're going to talk about revenue recognition and the matching principle, which I touched on just a few minutes ago. Okay? The time period concept. Businesses generally will break their books down into 12 months. Some businesses will take each one of the months and they'll break it down into 30, whatever the last day of the month is, that's the last day of that's their accounting period. It's from April 1st to April 30th might be a month, but they're breaking it down into individual pieces. Some businesses will also take their year and divide it up into months that will divide it into quarters. So if they divide it into quarters, they have 13 weeks in a quarter. You say, how do you get 13 weeks in a quarter? Well, take 52 divided by 4, that gets you 13. And then once you go from there, you're going to take, and you might say 5, 4, 4. You say, so the first month, let's say it's January, might be a 5-week month. And then February and March might be 4 and 4 weeks. But they say, well, January doesn't end exactly at the end of January. No, if you did a 5-week month, it could actually end February the 2nd for January. But what they're trying to do is have even quarters so that their financial statements look even. And they break them up so they can do financial statements. And that's kind of this time period concept, or the periodicity concept. Second thing you have is a fiscal year. The fiscal year has to do with, really, businesses will set up fiscal years that may be different than a calendar year. And think about a business like retailers, like say Kohl's. Kohl's will have a fiscal year that's different than the calendar year. Why? Because they want to take inventory when the inventory is lowest because it saves them money. It's a whole lot less hassle. And they order their business that way. So their inventory is low. Imagine if you are a company that cans and freezes vegetables. and you're a Midwest company that's based that cans and freezes vegetables. Well, they definitely don't want to have their close or their end of the year in September because their inventories are going to be the highest because through the summer they're packing all their inventory that they're going to sell for all the next year. So invariably what they want to do is they want to have their fiscal year, say, starting June 1st and ending May 31st of the next year because their inventories are going to be the lowest and they can't control it. So I'm just trying to give you a sense about what this time period concept is. And when you get into managerial accounting, you'll see that they do actual versus budget reporting based off of this time period concept. Revenue recognition says that you record revenue when it was earned. And it's not the same as when you collect the cash. You might get invoices. Some of you might have seen invoices where they show a net 30. That means that you're not going to pay them for 30 days. Well, if you're not going to pay them for 30 days, if you're on cash basis, they won't record the revenue until the cash came in. If you're on an accrual basis accounting, they're going to record the revenue when they did the work. So you have to be careful of that as well. Okay, so revenue is earned. When is it earned? When the goods or services are delivered and performed, and the earnings process is complete. You're not doing anything else for them. Now, the matching principle says you want to match revenues and expenses, because if you mismatch revenues and expenses, you're going to over or understate your financial results for a given period of time. And when you do that, it distorts the picture of the financial statements and ultimately may lead to erroneous or poor decision making, which may result in lower than expected profits or poor decisions that really adversely impact the business. So you want to match revenues and expenses. You don't want to not match them. So if you're a landscaping company and you have revenue for doing a work for a customer in January, you want to make certain you keep track of how much that revenue is, how much work you did, and also how much you paid for labor and materials to provide that landscaping service to a customer in January. So you're just trying to match them. If you did $10,000 worth of work and you had $5,000 worth of expense, your net income would be $5,000. But let's say you reported only the expense and not all the revenue. You could conceivably have a loss in January and a profit in February. You want to try and minimize or have profitability be consistent. And one of the ways you do that is the revenue recognition principle and matching principle. And really, these two principles are the basis for accrual basis accounting, which we're going to talk about now. And accrual basis accounting requires that you have to do adjusting entries, and you do two different types of adjusting entries. And what we're going to do is we're going to start off with this unadjusted trial balance. And we have different accounts on here, but what we're trying to do is make certain that we match revenues, and we also use the revenue recognition concept. And what we have here is we have two different types of journal entries. We have deferrals, or for deferred expenses, and we have accruals for accrued expenses. Deferrals are things like when you buy fixed assets like a truck. Well, you're not expensing that entire truck when you buy it. You're only expensing a portion of it each month, maybe based off of the miles or based off of some other measure. And you also have revenues that you have not earned yet that you're going to put in your balance sheet. Those are the two deferrals. And we talked about unearned revenue. This is one of the places we're going to talk about that. And then you have accrued expenses. Those are expenses that you know you're going to have, but you have not got an invoice for them, but you know you have them. So if you're running a trucking company and you did not get a fuel invoice for a month, but you know you have expenses, you're going to have to do what's called accrue for those expenses based off of the amount of gallons of diesel fuel that you purchased for your truck. And accrued expenses revenues are the reverse. Excuse me, not expenses, but revenues. Accrued revenues are revenues that you have done the work for, but you have not invoiced yet. And you want to make certain to account those, because if you don't do any of these, what happens is you paint an incorrect financial picture for your organization, inside and outside. So let's look at deferred expenses in a little bit more detail. Deferred expenses are advanced payments of future expenses, and they're treated as assets until used, and recognize it as expense by an adjusting journal entry. You can see some examples on the bottom here. There's three principal ones I have. They have prepaid rent, office supplies, and depreciation. And you might also see prepaid insurance. The concept holds the same. And for each one of these, we're going to go through an adjusting entry of the deferred expenses. But if you remember on your balance sheet, we had an account that was called prepaid rent. That's an asset. Office supplies is a rent. And depreciation really encompasses anything except for land that you're going to depreciate over time, because land does not depreciate. So if you have a building, you have machinery and equipment, you have a vehicle, you have computers, those are all things that are going to depreciate or lose value over time. And that's what we're going to talk about here. Prepaid rent. So here's the original entry for prepaid rent. And it shows on the bottom, it only shows you the debit and the T accounts, but the credit is to cash. So our typical journal entry, debit on the top, credit on the bottom, prepaid rent $3,000, cash $3,000. And it tells us it's for 3 months, so we know that rent is going to be $1,000 a month. But we want to do an adjusting entry for December. So we're going to take a third of the rent out of the prepaid rent account. We're going to credit prepaid rent, we're going to reduce it, and we're going to debit expense for $1,000. So now we have expense that we're going to expense out for the month. And we go to prepaid supplies. It's not really called prepaid supplies. It's office supplies on the account. And it doesn't show here when they bought this. But when they bought supplies, what they did, if they bought them for cash, they credited cash and debited office supplies. And then what they do is they go out and at the end of the month, they go count how many supplies they had left. And they take all the purchases are already in the account, so they've summed up to, in this case, $500. And then when they counted, they only have $100 left. So if they only have $100 left, they had to have used or consumed, or somebody must have stolen $400 worth of office supplies. So what we're going to do is we're going to use this ending balance, this $100, and we're going to set our new balance to $100. So that means we need to reduce office supplies $400 in asset, and we need to increase expense $400 to reduce to expense office supplies. Remember, we're following the matching principle here. Depreciation. Depreciation is expensing of long-term tangible assets, and the assets are used within the operation of the business, because you may have assets that are not used in the operation of the business that they're still holding. And what we're trying to do is show a decline in the value of the assets because we know that we've used those. And it's like deferred expense, and we're going to use an account called depreciation expense. And there's several different methods that you can use to depreciate an asset, but we're only going to cover here something called the straight line depreciation method. So what we have is, it says that, if you remember from the other chapters, Smart Touch has furniture for $18,000. The owner donated this furniture or gave this furniture to the company, and it has an $18,000 value. But the furniture is not going to always have an $18,000 value. They're going to depreciate it or lower the value because they're getting some kind of utility out of the furniture. It's really easy to understand this with, say, a machinery or a pickup truck, because you say, well, the furniture doesn't look any worse, even though they've used it a bunch. But by law, we have a way that we can expense some of the furniture value. So what we're going to do is we're going to allocate the cost, in this particular case, of the furniture over a value over a time. And then we're going to have something called, it says residual value, but it can also be the value of the asset after it's used up. That might be called salvage value. And that's what you expect you can sell it for when it's kind of used up. Straight line depreciation is the one we're going to use for allocating the depreciation for a year. And let's take a look at it. A straight line. We're going to take the original cost, which was the $18,000 that we saw, and we have no residual or no salvage value, and we have 5 years. So it says we're going to depreciate this asset, expense it $3,600 per year for 12, and we're going to divide it by 12 months, so we're going to depreciate it $300 per month. And for our journal entry, we have depreciation expense / furniture differentiated by, as opposed to equipment or building or whatever, furniture. And then we have accumulated depreciation furniture. This accumulated depreciation account, I want to point this out to you now. The normal balance is a credit, but it's a contra asset account. Remember, contra asset, you deduct it off of the value of the furniture, and then you've come up with something called the net book value. So we had $18,000 in depreciation in furniture, and we had $3,000 in accumulated depreciation. So the net book value, or the value that you expect the value of the furniture to be, is $17,700. And we use this accumulated depreciation account, and we talk about this book value that we just touched on. $18,000 less the $300 in depreciation expense, or accumulated depreciation, says the net book value is $17,700. And here's where it is, $17,700. And they give us another example for the building, $250. And you can kind of see what's going on here, and how this is just the long-term or long-lived assets that are used within the business. And you notice land has no depreciation here, none at all. Deferred revenue. It's revenue that the company is going to turn into revenue later. This is the unearned revenue account that we talk about. It's a liability. Businesses pay stuff in, or companies pay in, or individuals pay in. And then what they do is, as the company performs the service, they record the revenue. So we have a liability on our account. It's called unearned revenue. And then de facto, when they do the work, it's considered earned revenue. So here's our unearned revenue. It said that they paid $600 in advance. This law firm paid them $600 in advance for them to do some work. And now what's going to happen? They're going to take a third of it for each month. So in January or December, they're going to take a third of the $600 or $200, and they're going to adjust it out of unearned revenue and into service revenue. That's what you're going to try and do. And then you have accrued expenses, and these are just different types of expenses that you're going to accrue. Some is salaries that have been earned but have not been paid yet. And how can you have that? Well, you could have, depending upon how the business cutoff is, you could have salaries that are earned in a given week, but not going to be paid for another week or another 2 weeks. So you have to accrue that expense because you're managing expense. You want to match revenues and expenses. You also have interest expense and utilities. So you can see here the timing. It says it pays their employees on the 15th and the 30th, $2,400 and $2,400. So they have paydays on the 15th and the 1st. Well, if they have paydays on the 15th and the 1st, they have a certain amount of money that they're going to have to show to accrue for December, because they're not paying their December pay until January the 1st. So they have to recognize a $1,200 salary expense and a $1,200 salary payable. Okay, Smart Touch borrows $60,000 on December the 1st to buy a building. As of December 31st, Smart Touch incurs $100 interest on the note. So what we want to do is we're going to record a debit to interest expense and a credit to interest payable, because they're going to have to pay that out later. And we'll come back and do calculations on how to come up with the interest later on. We're not covering that in this particular part of the class. And you have accrued revenue. Those are revenue. Those are things that we did work for somebody, but we have not invoiced them yet. And what it's going to be is a debit to accounts receivable and a credit to service revenue. And here's what the journal entry would look like. It says they did work for somebody, but they haven't invoiced them. They said, only invoice me when you're done. Don't invoice me before. So if they've done work, say consulting fees for somebody, but they're not going to invoice them until the next month, they would have the expenses and not the revenue. So you would violate the matching principle. So what they need to do is do this adjusting entry. And here's kind of a review of all the adjusting entries in the original and then the adjustments. I want to make something really clear here, though. The reason that you do most of these adjusting entries is because you do not have a source document that tells you to do this. You actually have to do this based off of the information you have. And in fact, these things happen in the real world all the time. Now, systematically, depreciation is not manually calculated. It's done in a system. And most of the rest of this stuff is actually done in a system and posted. But all of these entries happen in the real world in accounting every single month, at least for the businesses that are following an accrual-based accounting system. So here's a summary of the adjusting entries and what happened to them. And you can see what this is. And this is Exhibit 3-4 in your book. I'm not going to spend a bunch of time here. You can read this. And what are we doing with this adjusted trial balance? Because what we've done is we've journalized and posted the adjusting entries. So we started off with the trial balance. Then we're going to do some And then we're going to do some adjusting entries. And then we're going to prepare an adjusted trial balance. Just like when we did the trial balance, we're doing the adjusted trial balance to check our bookkeeping and to make certain that we've accounted for everything correctly. And once we have an adjusted trial balance, we're going to look at the trial balance. And now we have the adjusted trial balance. And you notice we have some more stuff in here that we didn't have before. We now have accumulated depreciation twice. We have utilities payable, salaries payable, interest payable, and unearned revenue payable. We had unearned revenue before. And then you have these expense accounts. And you notice down here we have 3 new ones on 4, probably 5 new ones on the bottom, 6 probably. At least 5 new ones, or 6 maybe on the bottom. Probably 5 new ones. Supplies, utilities, depreciation expense, building and furniture, and interest expense. Each one of those accounts are new. And now we do the financial statements. And the last thing you have here is what happens. First, what are we doing with the adjusting entries? We're making certain that the adjusting entries are correct and that the account balances. And then if you don't do the adjusting entries, you can see what happens, and we're going to talk about that. I'm not going to go through a lot of detail on this. The most important thing about the adjusting entries is that you make certain that they get impacted in the financial statements, and we're looking to match revenues and expenses. If you don't do the adjusting entries, what's going to happen is your financial statements are going to get off, and the businesses are going to make poor operating decisions based off of inaccurate financial statements. So the whole intent of this is to adjust the accounts to make certain that they accurately reflect the financial condition of the organization. If they do not, there's something incorrect. And that concludes chapter 3 for Accounting 221. Hope you have a great day, and I'll see you on chapter 4. Thanks.